You're looking at a stock chart. Maybe you've been following a particular company.
Yeah.
And you see the price getting close to a level where it's bounced before, or maybe stopped climbing. There's that familiar jolt, right?
Oh, yeah.
That mix of anticipation and, well, uncertainty as you watch it approach that line in the sand. Will it break through? Will it turn around? That feeling, the art of trying to figure out what comes next by looking at the patterns history has left on the chart.
Yeah.
That's what grabs us, isn't it?
It absolutely is, because you're not just observing numbers and lines, you're seeing the footprint of collective human behavior, of past decisions made by thousands, maybe millions of market participants, all, condensed onto a graph.
Right.
And understanding those footprints gives you clues about where the crowd might go next.
Exactly. And that's really the core of this deep dive. We're plunging into the world of technical analysis, using charts to gain an edge in navigating market movements. Specifically, we're focusing on two cornerstone concepts that underpin so much of what you see on a price chart: support and resistance.
The big ones.
Yeah, those crucial price levels, or maybe more accurately, price zones, where the tug of war between buyers and sellers tends to reach a decisive moment.
Mm-hmm.
And just as critically, we'll unpack how volume acts as the essential validator, the key to identifying real trading breakouts, as one of our sources emphatically puts it, confirming whether those moments at support or resistance have genuine conviction behind them.
And we've gathered quite a stack of material for this exploration. We're drawing from, a range of articles and research excerpts covering the fundamental principles of technical analysis, some fascinating insights from behavioral finance that help explain why these patterns even recur.
That's key.
Detailed guides specifically on how to identify and use support and resistance, and a really good look into the practical application of volume to confirm key price action.
So our mission in this deep dive is to take this wealth of information and really distill it for you. We want to go beyond just defining support and resistance to truly understand their nature, why they form, how they behave, how they can even change roles. Exactly. And we want to see how volume layers onto this, providing that crucial confirmation signal you need to differentiate high probability events from just market noise.
Right.
By the end of this, you'll have a more refined understanding of how to combine these ideas to make more informed decisions when you're interpreting charts yourself. You already follow this space, you get the basics, so we're here to add that nuance, practical application, and hopefully some of those aha moments that come from connecting the dots.
Okay, let's get into it. When we talk about technical analysis, what we're really talking about is using charts to understand market history and, try to predict future movement.
Right. It's analyzing past price data, often alongside volume and other market data, to project where a security's price might go. It's fundamentally different from fundamental analysis.
Totally different beast.
Which looks at the underlying value of a company, its financials, industry trends, management, all that stuff, to decide what to buy or sell. Technical analysis is much more about when to buy or sell.
Precisely. You could be fundamentally bullish on a stock, thinking it's a great company, but technical analysis helps you time your entry or exit to potentially maximize your returns or, minimize your risk.
Makes sense.
Our sources are quick to point out, though, it's not a perfect science. Not by a long shot. It's often described as an art form that demands practice and judgment. You're interpreting probabilities based on historical tendencies, not predicting the future with certainty.
That art form aspect is really key, I think.
Yeah.
It's not just about following some rigid set of rules. It's about recognizing patterns and understanding the market psychology driving them. So where do we even begin within this art?
The absolute bedrock. And that really starts with understanding market structure, specifically trends and support and resistance. Trends show you the general direction of momentum where prices are likely headed.
Yeah.
Support and resistance levels pinpoint those specific price areas where that momentum is likely to pause or potentially reverse.
I still love that analogy from one source about trading with the trend being like swimming downstream. It just feels so much easier than fighting the current.
It's a vivid way to put it, yeah. Trying to pick bottoms in strong downtrends or tops in strong uptrends is often a low probability game. Identifying the trend is your first step.
How do you do that reliably?
It involves looking at the sequence of swing highs and swing lows on the chart. A clear uptrend is marked by a series of higher highs followed by higher lows. Simple enough.
Right. Up, pull back slightly higher, up again.
Exactly. A downtrend shows a sequence of lower highs and lower lows. And a sideways trend, or a trading range, is characterized by highs and lows that occur at roughly the same price levels. back and forth.
And it's not just one trend happening at once, is it? You've got trends within trends, different time frames.
Absolutely. That's crucial. You might see a strong multi-year or long-term uptrend on a monthly chart, but zoom into a weekly chart, and you could be in an intermediate-term correction or even a short-term downtrend on an hourly chart.
So alignment matters.
Hugely. A crucial point from our sources is the importance of identifying trends across these different time frames and, where possible, finding alignment. The highest probability technical trades often occur when the trend on your primary trading time frame, let's say the daily chart, aligns with the trend on a longer-term time frame, like the weekly part.
Okay.
So if the weekly trend is up and the daily trend is also up, maybe after a little pullback, that alignment gives you a much stronger directional bias.
It's like understanding the bigger picture current before you decide how to navigate the local rapids. Makes sense.
Exactly. So with the direction established by trends, support and resistance are the potential obstacles or turning points along that path. Let's really dig into those now.
Okay, let's do it. Section 1, understanding support and resistance, the floors and ceilings. Break it down for us, maybe add some of that depth for listeners who already know the basic terms.
Right. So at its core, support and resistance are these dynamic zones on a chart. They represent areas where the balance between buying pressure demand and selling pressure supply has historically shifted or is expected to shift. They aren't magic lines. They're reflections of past market behavior that influence future behavior.
So support is where demand tends to overwhelm supply, like a floor holding the price up.
Precisely. Think of support as a price zone where, as the price declines towards it, buying interest tends to increase significantly. At the same time, selling pressure might diminish.
Why would that happen?
Well, buyers who previously missed an opportunity might see value returning as it gets cheaper. Existing buyers might look to add to their positions. Sellers who are already short might look to take profits and cover. Essentially, as the price gets cheaper near support, the incentive to buy increases relative to the incentive to sell.
Okay.
And if demand actually exceeds supply there, the price decline halts or reverses. It acts like a floor.
And resistance is just the opposite, the ceiling, where supply tends to overwhelm demand.
Correct. Resistance is a price zone where, as the price rises towards it, selling pressure mounts. This could be traders taking profits after a good run.
Makes sense.
Or new sellers, short sellers, initiating positions because the price seems expensive or overextended. Buyers, seeing the price higher, might become hesitant, less eager.
So the incentive shifts.
Exactly. As the price approaches resistance, the incentive to sell increases relative to the incentive to buy. And if supply exceeds demand, the price advance slows, halts, or reverses. It acts like a ceiling.
And when supply and demand are relatively balanced within a range, bouncing between those two levels, that's when you see those sideways trends or trading ranges we mentioned earlier.
Exactly. Price just chops back and forth between a defined support zone and a defined resistance zone. It signals that neither the buyers nor the sellers have the sustained conviction to push the price decisively in one direction. That creates the range-bound environment.
Okay, this brings us back to that crucial question, though. Why do these zones actually have this effect? What's the underlying mechanism beyond just saying supply and demand? Our sources really emphasize the psychological aspect here.
They do, and this is where it gets really interesting. These levels aren't random. They form because they represent price points where significant emotional or logistical events occurred in the past.
Yeah.
Traders remember these points.
Like price levels where major reversals happened before.
Yeah.
Or where a ton of shares changed hands.
Yes,
Yeah.
exactly. Or where large volumes traded. Consider the psychological reasons our sources outline. Traders who regret not buying at a previous low support might place buy orders there if the price returns, thinking second chance.
Uh-huh.
Traders who bought near a previous high resistance and then watched the price fall might see it return to their entry point as an opportunity to just get out, escape with a minimal loss, or break even.
Ah, okay. That creates selling pressure right there.
Right at that former high.
That ties perfectly into those behavioral finance concepts, doesn't it? Things like loss aversion, where the pain of a loss feels way stronger than the pleasure of an equal gain. Someone stuck in a losing position might be heavily motivated just to get back to zero.
Absolutely. Loss aversion can absolutely solidify resistance. If you bought at $50 and the stock tanks to $40, you feel that pain. If it somehow rallies back to $50, you might be incredibly tempted to sell just to avoid locking in that loss, even if the stock's prospects are actually improving now.
Wow.
That collective behavior creates supply at the $50 level, reinforcing it as resistance.
And what about representativeness, where traders might overgeneralize from like just one or two bounces?
Right, good point. If a stock bounces hard off $30 twice, a trader using representativeness might start to believe $30 is this impenetrable floor, like it'll hold forever, even if the underlying company situation changes drastically.
So they pile in with buy orders there.
They might place aggressive buy orders at $30, contributing to demand, until that belief system gets shattered by a decisive break. Overconfidence can play a role too. Maybe you made money buying off that level before, so you get overly confident and take too much risk next time.
And fear of regret. FOMO.
Oh yeah, fear of missing out. FOMO, if the price rallies sharply away from support without you, or the fear of giving back profits if it plunges from resistance, that definitely drives action at these key levels too.
So these levels are really sticky because they represent points of collective psychological significance and all these behavioral biases interacting.
Precisely. It's not just abstract supply and demand curves. It's supply and demand heavily influenced by memory, biases, and the emotional reactions of actual human traders interacting with price history. Our sources highlight that while these biases don't always lead to, perfect market inefficiency, they absolutely influence trader behavior at specific remembered price points. And that, in turn, helps create these repeatable S&R dynamics.
And that perfectly explains that concept you mentioned earlier, overhead supply. Like with that PeopleSoft example. Buyers got trapped at 18.
Exactly.
And when the price finally crawled back up there months later, those unhappy buyers were just waiting to sell and escape.
Right. They were influenced by loss aversion, the desire to avoid regret, and they provided that wave of supply right at their break-even point. Understanding the psychological basis makes S&R so much more than just lines on a chart. It's about understanding the market participants themselves.
Okay, let's re-emphasize a crucial point before we move on to actually drawing these things. S&R is zones, not precise lines. This seems really important.
Absolutely critical. You really should think of them as areas or bands on the chart where price action tends to get noisy and turns are more likely to occur. One source used the analogy of drawing with a large marker rather than a fine-tipped pen. I like that.
So don't expect price to bounce exactly off $50 every single time.
Almost never. It might bounce at $49.85 one time, $50.15 the next, or it might chop around in a range between, say, $49.50 and $50.50 before finally turning.
Okay.
Using a zone, like saying $1,400 to $1,420 is support on the S&P 500, instead of insisting on exactly $1,410, accounts for that market noise, those temporary little probes beyond the exact historical point. It stops you from getting faked out by tiny breaches. It gives the level room to breathe, really, and for the market dynamics to play out.
Got it. Zones, not lines. And the principle of support becoming resistance and resistance becoming support. This seems like the most powerful demonstration of how these psychological levels actually flip roles once broken.
It absolutely is, and it's fundamental to understanding price action after a breakout or breakdown. When a price level that previously acted as strong support is broken decisively, it very often becomes resistance on subsequent rallies. The opposite is true for broken resistance becoming support.
Let's revisit those examples from the sources to make this really concrete. The Halliburton HAL example is pretty clear.
Yeah, that was a good one. Halliburton had clear support around $42.50 back in September. When that level really broke hard, the selling pressure just overwhelmed demand. Later, when the stock tried to rally back up from its October lows,
that same $42.50 level stopped it.
Exactly. That $42.50 area, which was the floor, now acted as a ceiling. Traders who'd bought at $42.50 and were now underwater likely used that rally as their chance to sell and get out near break-even, creating that supply. The price failed multiple times right around there.
And the NASDAQ Q100 NDX breaking above 935 in May 97.
Right. That 935 level, which had been resistance, then became the new floor. It was tested again as support after the index had climbed much higher, up to 1150.
So the psychology flips.
It does. The previous sellers at 935 might now be potential buyers, maybe regretting selling too early and seeing the return to 935 as a second chance. Buyers who missed the initial breakout might see 935 as a confirmation point and an attractive entry.
And PeopleSoft was the other classic case.
Yeah, support at 18 held for months, late 98 to early 99, then it broke in March 99. And guess what? That 18 level then served as strong resistance from June all the way to October 99. Again, that overhead supply from those unhappy buyers trapped at 18 was a huge factor. This principle of polarity S&R flipping rolls is just a consistent and powerful pattern you see on charts, linked directly back to those psychological reactions at remembered price points.
Okay, so we understand what SNR are, why they form psychologically, and how they flip roles. But the practical challenge is identifying them and drawing them correctly on a chart. It feels easy to just, get lost in all the noise.
It is, yeah. And one of the biggest pitfalls, as our sources definitely warn, is cluttering your chart with way too many insignificant levels. It leads to paralysis by analysis.
Guilty as charged sometimes. My chart looks like a toddler went wild with a box of crayons.
Happens to the best of us. Other common mistakes include drawing them as those perfect thin lines instead of zones, ignoring older, historically significant levels just because they happened a while ago. That's recency bias at work.
Focusing only on the last few weeks.
Right, and not looking at multiple time frames. A level that looks pretty minor on an hourly chart might be hugely important on a weekly or monthly chart.
Okay, so let's lay out the rules then. How do you filter the noise and draw the right levels, the ones that actually matter?
Okay. Our sources give 4 key rules or maybe guidelines for identifying significant S&R. First, zoom out. Always start by looking at higher time frames weekly, and daily charts are essential. These show you the most established long-term levels that have demonstrated significance over extended periods.
Find the biggest battlegrounds first, the major historical turning points.
Exactly. Second, draw only the most obvious levels. This is crucial for avoiding that clutter. If you have to squint or zoom way in or spend minutes debating if a little wiggly bit of price action counts as support, it probably doesn't matter that much. Focus on price zones that show clear, undeniable evidence of past reactions, sharp turns, sustained pauses or consolidations, maybe significant trading volume occurred there. If it doesn't kind of scream, "I'm important" at you, just ignore it. Keep it clean.
So levels where price decisively stopped or reversed, maybe multiple times if possible.
Yes, which leads into the 4th rule, but we'll stick to the order for a sec. The 3rd rule is draw zones, not lines. We've hammered this point, but it's so vital for practical application. Capture the area where price has repeatedly struggled or found footing. Use a thick marker or a shaded box on your charting software. Give the level a range.
Got it. Wide berths, not tight ropes.
Precisely. Now, the 4th rule, and this is where it gets a little more nuanced, prioritize strong reactions over sheer frequency of touches.
What does that mean exactly?
It means a level where price hit and reversed sharply and decisively with real conviction, maybe marked by long wicks on the candles, or large, fast candles moving away from the level. That level is often more significant than a level that's been touched, say, 10 times, but with weak, choppy, uncertain reactions each time.
Okay.
In fact, sometimes multiple tests of a level can be a sign that the pressure holding that level is actually weakening with each hit. The bounces might get less energetic, suggesting the buying or selling interest there is drying up.
That is counterintuitive.
Yeah.
You'd think more tests equals stronger. But it makes sense, like a door being repeatedly pushed. Eventually, the hinges might loosen or the wood might give way.
That's a really good way to think about it. A strong, immediate bounce shows robust conviction by buyers at support or sellers at resistance. Repeated weak tests might show that conviction is fading. So yeah, prioritize levels that have shown dramatic responses in the past.
Okay, so summarizing the rules. Zoom out first. Find only the really obvious zones. Draw them as zones, not lines. And look for levels with strong reactions, maybe prioritizing those over levels with lots of weak touches. These levels can be horizontal or diagonal, right?
Yes, both are important. Horizontal S&R are the classic levels we've mostly discussed, occurring at fixed price points, like that $77.50 level on Caterpillar mentioned in one source, which acted first as support and then flipped to resistance.
Okay.
Diagonal S&R are basically sloping lines that follow the trend. Think of trend lines. You connect a series of higher lows in an uptrend to form a rising support line, or connect lower highs in a downtrend to form falling resistance. When you have parallel trend lines, they form a trend channel.
Right. Defining the path.
Exactly. Our sources really stress that these diagonal lines are invaluable in trending markets and that combining both horizontal and diagonal analysis gives you a much more robust picture of the market structure.
So you might be in an uptrend defined by a rising channel that's your diagonal support and resistance. But you could also have horizontal resistance levels from previous swing highs or just old price memory blocking away.
Exactly. And price can react to both simultaneously. The most significant resistance, for instance, might be where a major horizontal level happens to converge with the upper boundary of that rising diagonal channel. That confluence makes it a stronger potential turning point.
Okay. How do we apply this knowledge differently in different market conditions, say trading ranges versus trending markets?
Good question. In trading ranges, those sideways markets, S&R basically defines the boundaries of the range. You identify the extreme highs and lows of that range using the drawing rules we just talked about.
Find the top and bottom of the box.
Pretty much. One source even offers a simple three-step trading range formula. 1. Identify the absolute extreme highs and lows of the range. 2. Adjust those levels slightly to form zones that capture most of the price action and maybe the tips of the wicks. 3. Identify any less significant internal S&R levels within the range that prices reacted to.
That's strategy there.
Strategies and ranges are typically either trading the range, so buying near the support zone, selling near the resistance zone, or alternatively, waiting patiently for a decisive breakout from the range, either up or down. The WorldCom range example, around 55 to 63, and the Lucent range, roughly 40.5 to 47.5, were classic illustrations of this from the sources.
And in trending markets, what's the focus?
In trending markets, horizontal S&R still exists from past price action, absolutely. But diagonal S&R, those trend lines and channels become particularly important guides. In an uptrend, you look for support at previous swing lows and along the rising trend line that defines the channel's lower boundary. In a downtrend, you look for resistance at previous swing highs and along the falling trend line defining the channel's upper boundary. Price often seems to ride these diagonal levels for extended periods. That Caterpillar downtrend channel example from late 2007 was a clear illustration of how diagonal resistance and support can guide price steadily lower.
Okay, so we've identified the levels, horizontal and diagonal, in different market types. Now we get to the really key moment. Predicting when a level might break, signaling an acceleration of the prior move versus when it might hold and cause a reversal. This is section 3. Predicting breaks and identifying strong bounces. What signals should we be watching for?
Yeah, predicting breakouts before they happen is definitely challenging, but it can be very rewarding if you get it right. Our sources point to specific behaviors as price interacts with S&R that suggest a break is becoming more probable.
Okay, what are those signs? How do we spot an impending breakdown or breakout?
Well, one key signal is seeing higher lows into resistance. This typically happens in an uptrend where buyers are getting more aggressive or maybe just impatient. They start stepping in to buy the dips at progressively higher prices before the price even gets back down to the established support zone, pushing up towards resistance.
Showing increasing buying pressure.
Exactly. It shows accumulation occurring just below that ceiling. Visually, it often takes the form of an ascending triangle pattern. The opposite, naturally, is lower highs into support. That's where sellers become willing to sell at progressively lower prices as price approaches a support level, showing increasing selling pressure building above the floor. That often forms a descending triangle pattern.
So in both cases, the range of price movement is sort of compressing as it pushes against the level, like it's getting squeezed.
Exactly. That's a great way to put it. It's like a spring coiling tighter and tighter against that S&R barrier. Another sign is price hugging the level. If, instead of bouncing sharply away from support or resistance, the price starts trading very tightly right along the S&R level, maybe with small, choppy candles and very little pullback.
It's just grinding sideways right at the edge.
Yeah. That suggests the opposing pressure holding the level might be weakening. The buyers at support or the sellers at resistance aren't stepping in with the same conviction they used to. The defense is getting tired.
And you mentioned earlier that multiple weak tests could also signal weakness, right? Not strength.
Yes, precisely. If a level gets tested repeatedly, but the bounces become progressively smaller or the pullbacks shallower each time, it can mean that the pool of buyers at support or sellers at resistance is getting depleted. The level is getting worn down by the repeated attempts, increasing the likelihood of an eventual break.
Okay, so to recap the signs of a potential break. Higher lows pressing into resistance, lower highs pressing into support, price hugging the level tightly, and diminishing reactions on repeated tests.
Got it. Now, what about the other side? What are the signs that a level is likely to hold and cause a strong bounce or reversal?
Right. Here you're looking for signals of strong conviction right at the level itself. One interesting sign is strong momentum into the level. If price comes crashing down into a support level after a very sharp, fast decline, or screams vertically upwards into resistance after a huge rally.
Like a parabolic move?
Yeah, exactly. Those very rapid, almost climactic moves often lead to equally sharp and rapid reversals. This often results in the quick rebound. Price doesn't hang around at the level. It hits it and bounces hard and fast away from it.
So a fast fall into support often leads to a fast bounce out of support. Often, yes. It's counterintuitive again, but that speed can signal exhaustion of the move. And this relates closely to the third sign, minimal time spent at the level. A price touch and go, where the price just tags the level and immediately reverses course, is often a stronger sign of a durable bounce than price that lingers, consolidates, or chops around the level for an extended period. That minimal time suggests a conviction of the reversal is immediate and powerful.
Why does hitting it fast and bouncing fast indicate strength, though? Seems like it could just be volatility.
It could be, but think about the mechanics. Rapid moves can create very clear opportunities for counter-trend traders. If price tanks rapidly down to a well-defined support level, buyers who wanted to get in low have a very obvious entry point, and they also have a very clear place to put their stop loss just below the level. This concentrated demand can create a sharp snapback rally. Similarly, if price explodes upwards into a known resistance level, short sellers see a clear level to initiate bearish positions with defined risk, and existing longs might feel sudden pressure to lock in those fast profits. That can create a sharp reversal lower. The speed indicates strong conviction and a rapid shift in the supply-demand balance right at that specific point.
Okay, that makes sense. So building pressure or price hugging suggests a potential break is coming, while strong momentum into the level followed by a quick, minimal time bounce suggests the level is more likely to hold. This leads us perfectly into confirming those potential breaks. How do we know if a break is real and not just a fake out?
Yes. This is where volume becomes not just helpful, but absolutely critical. Section 4, confirming breakouts with volume. A breakout happens when the price moves decisively beyond a significant S&R level. But false breakouts, where price briefly pierces the level only to snap right back, are incredibly common and can be painful traps for traders.
Yeah, I've been there.
We all have. Volume is your primary tool to help filter the real moves from the fake ones.
Why is volume so important for confirmation here? What's it actually telling us?
Volume is basically a measure of market participation and activity. It tells you how many shares or contracts actually changed hands during that price move. A genuine breakout represents a fundamental shift in the supply-demand equilibrium. Either demand has finally truly overpowered supply at resistance, or supply has finally crushed demand at support.
Right.
For this shift to be sustained, you generally need broad market agreement and conviction behind it. High volume occurring during the breakout provides that confirmation. It shows that a large number of participants are voting with their capital, actively supporting the move past the level. As one source put it very powerfully, without volume, even perfect chart patterns fail.
Wow. Okay, so a low volume breakout is immediately suspicious.
Highly suspicious. It suggests the move past S&R isn't backed by significant market conviction or broad participation. It might just be driven by a few large orders or simply a lack of opposing pressure at that moment, but not active buying or selling interest. These low-volume moves often reverse quickly, trapping traders who jumped in on the perceived breakout.
So for a breakout to be considered validated, you need that surge in volume.
Yes. Our sources consistently emphasize the need for a significant surge in volume as the price moves through the S&R level.
What kind of surge are we talking about? Are there actual benchmarks or rules of thumb?
Yeah, the sources provide some helpful guidelines here. A reliable breakout should ideally show volume that's at least 50% above its recent average volume, often measured using something like a 20-day moving average of volume.
Okay, 50% higher.
That's kind of a minimum. They even give more specific thresholds for judging the strength of conviction. 1.5 to 2 times the average volume, that's 50% to 100% above average, suggests moderate conviction. 2 to 3 times average volume suggests strong conviction. And anything over 3 times the average indicates very strong belief in the direction of the breakout.
That's clear.
Even a move on volume that's only, say, 23% above average is mentioned as potentially significant if it's accompanied by other strong technical signals confirming the move. But generally, the bigger the volume surge, the better.
And the timing is critical, right? The volume spike has to happen right as the price is crossing the level, not before or after.
Absolutely. Timing is everything here. You're looking for a notable surge in trading activity right as the price moves past S&R. If the big volume surge happened days before the price actually broke the level, or if it lags significantly after the price is already way past it, it's much less convincing. That burst of activity needs to coincide with the break itself.
What about volume divergence patterns? You mentioned those briefly. How do they help confirm or maybe warn us?
Volume divergence is a really important concept. It happens when volume isn't confirming the price action, and it often acts as a major warning sign.
It's like price going up but volume going down.
Exactly. That's classic bearish divergence. If you see price rallying, pushing into new highs, or retesting a key resistance level, but the volume on that move up is steadily declining, that's a red flag.
Why?
It means buying interest is actually fading as the price gets higher. The rally lacks broad participation and conviction. It suggests a resistance break is unlikely to hold, or that a low volume breakout might be prone to failure.
Okay.
Conversely, if you see rising volume on a falling price, maybe price is breaking down through support into new lows that confirms the downward pressure. Strong selling interest confirms the potential breakdown.
So declining volume on rising price, red flag for bulls.
Right.
Rising volume on falling price, confirmation for bears.
Got it. You got it.
How would a trader actually use all this information to trade a breakout in practice? Could you walk us through the steps?
Sure. It really starts with the S&R analysis we already covered. First, you identify those key S&R zones using the rules. Zoom out. Obvious levels, zones not lines, strong reactions.
Okay, levels identified.
Then you watch the price action carefully as it approaches that zone. Are you seeing any of those signs of building pressure we talked about, like higher lows pushing into resistance or lower highs pressing on support? Or is the price starting to hug the level, suggesting weakening opposition?
Monitoring the setup.
Exactly. Then, as the price begins to actually move through the S&R zone, you immediately shift your focus to the volume.
Looking for that spike relative to average.
Precisely. You're looking for that surge well above average, ideally hitting those benchmarks of 150% or more relative to the 20-day average volume for the initial breakout candle, or maybe the first hour of the break. Then, crucially, you look for follow-through confirmation, meaning, is the volume on the next few candles, or perhaps the next trading day, still strong? Maybe not as high as the initial spike, but still well above average, say above 100% of average, as the price continues to move in the breakout direction. That shows continued commitment.
Okay, and what if there's a pullback right after the breakout? Price breaks resistance, then dips back towards it.
That's a very common and important test. If the price pulls back slightly to retest the broken S&R level, which should now ideally act as support after a resistance breakout or resistance after a support breakdown, you want to see that pullback occur on low volume.
Low volume on the pullback, why?
Low volume on a pullback indicates that the sellers, in an upside breakout scenario, lack conviction at that level. They aren't rushing back in aggressively to push the price back below the broken resistance. It suggests the path of least resistance is now higher. One source suggests pullback volume should ideally be below 50% of the initial breakout volume. A high volume pullback back to the breakout level is a definite warning sign that the breakout might be failing.
That's a really structured step-by-step approach. And you mentioned a tech stock example earlier that illustrated this.
Yes, it was highlighted in the sources as a clear case study. A tech stock broke above its key $100 resistance level. The crucial part was the volume surge, reportedly 250% above its average volume right on the breakout.
Wow, 2.5 times normal volume.
Yeah, and that strong conviction signal preceded a subsequent 20% rally. Now, obviously, that's just one example. It's not a guarantee. But that level of volume validation significantly increases the probability of a sustained move.
What are some common mistakes traders make when trying to use volume to confirm breakouts?
Well, one big one is focusing only on the volume spike of the single breakout candle in complete isolation. While that initial spike is key, you should also look at the volume trend leading up to the breakout. Was volume generally increasing as price approached the S&R level, showing building energy and interest? That adds context.
Okay, look at the lead up too.
Another mistake is using a fixed volume threshold, like insisting it must be 2x average volume, without considering the overall market environment. In generally quiet, low-volume market periods, a breakout on only 1.5x average volume might still be very significant relative to the recent norms. Always compare the current volume to the security's own recent volume history, not just some static, absolute number. Context matters.
Good point. And risk management, this feels absolutely crucial with breakouts, given the possibility of false ones.
Absolutely non-negotiable. Trading breakouts, even those confirmed by volume, is about identifying high-probability setups. But probabilities are never certainties. You must define your risk before you even think about entering the trade. For a resistance breakout, buying, you place a stop-loss order just below the broken resistance level, which should now act as support. If the price falls back below this level decisively, the breakout has failed, and you get out with a small predefined loss. For a support breakdown, selling short, you place a stop-loss just above the broken support level.
Protecting your capital.
Always. And related to that is capital allocation. Always allocate only a small percentage of your trading capital to any single trade. The common advice is 1–2%. This ensures that even if you hit a string of losing trades due to false signals or just unexpected market news, no single loss can cripple your account.
Makes sense.
Now, if a volume-confirmed breakout is successful and the price holds above the level with continued steady volume, you might consider adding to your position, maybe on a low-volume pullback, but always manage your overall risk exposure carefully. Using trailing stops, perhaps based on a volatility measure like the average true range, ATR, can also help you lock in profits as the trade moves further in your favor while giving it room to breathe.
So volume helps confirm the signal's probability, but robust risk management is what protects your capital when the signal inevitably fails sometimes.
Precisely. It's the essential partner to any technical analysis strategy. Now, while understanding price action, SNR, and volume manually is really the foundation, there are other tools that can help enhance this process.
Okay, Section 5, combining volume and support resistance with other tools. What else should traders potentially look at to strengthen their analysis?
Well, candlestick patterns are a fantastic complement. They give you these quick visual clues about market sentiment and conviction within a specific time frame, like a single day or hour. Combining these patterns with volume confirmation, especially when they occur right at key SNR levels, strengthens their reliability significantly.
So for example, seeing a classic bullish pattern like a hammer candle with that long lower wick form right at a confirmed support zone.
Exactly. And then the next step is checking the volume on that specific hammer candle. Was it high? Our sources point out that powerful reversal patterns like the bullish engulfing, the hammer, or the three white soldiers, 3 strong up candles in a row, are much more reliable signals near SNR or during breakouts when they occur with clearly above average volume.
How much volume? Same benchmarks.
Often similar requirements, yeah. They often need volume greater than 150% of average, and sometimes the sources suggest even higher thresholds, like over 200% or 250% average volume, for really strong confirmation of these patterns. Conversely, if you see a potentially bullish pattern forming, but it's on really low volume, say below 50% of average, or you see an ambiguous candle like a doji, but it has an unusually massive volume spike, those should be treated with extreme caution. They might be misleading.
Okay. What about technical indicators? There's a whole universe of those out there. Seems overwhelming sometimes.
It can be. The key, according to our sources, is that indicators should be used to enhance and confirm your primary manual analysis of price, SNR, and volume, not replace it. They are tools derived from price and/or volume data, and there are specific indicators directly relevant to what we've been discussing.
Can you give us some examples from the sources? Which ones are particularly relevant here?
Sure. For volume analysis, beyond just looking at the volume bars themselves, you have indicators like on-balance volume, OBV. OBV is a cumulative indicator. It basically adds volume on up days and subtracts volume on down days. The trend of the OBV line is key. If the price is making new highs, but the OBZ line isn't confirming with new highs, that's divergence again, it suggests the upward price move isn't being fully backed by volume, potentially signaling underlying weakness. It's often considered better for spotting longer-term volume trends and momentum shifts.
Okay, OBV for cumulative flow. What else?
Chaikin Money Flow, CMF, is another popular volume-based oscillator, typically calculated over 20 or 21 periods. It tries to measure the degree of buying or selling pressure over that recent period. It looks at where the closing price falls within each candle's high-low range and weights that by the volume for the period. Readings consistently above a certain level, like plus 0.20, suggest strong buying pressure and can help validate a bullish breakout. Reading below -0.20 suggests strong selling pressure, confirming bearish moves. It's often seen as useful for confirming shorter-term breakouts and money flow shifts.
And VWAP. You hear that mentioned a lot, especially for day trading.
Right. Volume-weighted average price, VWAP, is particularly useful for intraday trading. It calculates the average price a security has traded at throughout the current day, weighted by the volume at each price level. Significant trading volume often occurs around the VWAP line, so it frequently acts as a dynamic intraday support or resistance level itself. Institutions often use it as a benchmark.
Interesting. And what about indicators specifically designed to help identify SNR levels?
There are tools that attempt to automate SNR identification, though manual identification is still crucial. Pivot points highs and lows indicators can automatically plot significant historical swing highs and lows on your chart based on a specified look-back period. Maybe 20 periods or so is often recommended. You can then look for clusters of these plotted points. Areas with many historical pivot points often tend to act as stronger SNR zones.
Okay, finding historical congestion.
Exactly. Trendline indicators, sometimes with features to automatically identify pivot points or show crosses where lines intersect, can help you draw those diagonal S&R channels we discussed earlier. They can help visualize the trend and identify potential breakout points when price reaches the channel boundary. And then there are some more advanced indicators, like one mentioned called LuxAlgo's auto support and resistance levels, which attempt to combine various approaches looking at pivots, price swings, maybe volume profiles, to automatically draw both horizontal and diagonal levels, and sometimes even highlight when breaks occur with specific signals.
So these indicators can essentially help you spot levels you might have missed manually, or just reinforce what you're already seeing visually on the price chart.
Precisely. They offer a different mathematical or visual perspective on the same underlying price and volume data. And you can layer in other confirmation tools too. For instance, if price is breaking above resistance with high volume, you might also check, is it simultaneously moving above key moving averages, like the 50-day or 200-day moving average?
Adding another layer of confirmation.
Right. Or are momentum oscillators like the Relative Strength Index, RSI, or MACD confirming the strength? Maybe RSI is moving above 70, indicating strong momentum in a breakout, or you're getting a fresh MACD bullish crossover signal. The goal isn't to rely on any single indicator, but to look for confluence.
Confluence.
Yeah, confluence is when multiple, preferably non-correlated signals are all pointing to the same conclusion, confirming your core analysis based on price action, support resistance zones, and that crucial volume confirmation.
So the strongest signals really come from combining multiple layers of analysis, starting with the fundamentals of price, S&R, and volume.
Exactly. Indicators are powerful when used intelligently to validate analysis derived from understanding the market dynamics reflected in price and volume, rather than used blindly in isolation as magic buy-sell signals.
Okay. So let's bring it all back to that moment our listener started with, staring at that chart, wondering if that support level is going to hold this time or if the price is finally going to break through that stubborn resistance. What's the big takeaway from this whole deep dive?
I think the core takeaway is that technical analysis provides this really powerful framework for interpreting market behavior, and support and resistance, understood as these dynamic zones shaped by market psychology and past price action, are absolutely fundamental to this framework. But crucially, using volume analysis to confirm potential breakouts or validate bounces is what really elevates this analysis from just, drawing lines and guessing to a strategy focused on identifying higher probability trading setups.
And the volume is key.
Well, high volume breakouts, ideally supported by follow-through volume and then low volume pullbacks, are statistically more likely to lead to sustained moves. Volume gives you a read on the market's conviction.
And it's still not about predicting the future with 100% accuracy. Right?
Not at all. Never is. It's about understanding where those significant supply and demand battles have occurred historically, watching carefully how price interacts with those zones now, and using volume to gauge the conviction behind any potential shift in that balance of power. And importantly, combining this analysis with the disciplined risk management, always setting stop losses, always managing your capital properly, allows you to define your potential loss before you ever enter a trade, while positioning yourself for potential gains in those higher probability scenarios that have been confirmed by volume.
So by focusing on mastering support and resistance as zones, really understanding their psychological underpinnings and how they flip roles, and then integrating rigorous volume analysis for confirmation, you can significantly enhance your ability to read the charts and navigate the markets with maybe a bit more confidence and structure.
Absolutely. As our sources clearly show, market charts contain just a wealth of information locked within them. Learning to effectively interpret S&R and volume is how you start to unlock that hidden language of the market.
Okay, that brings us to our final provocative thought for you, the listener, to carry forward. We've explored how individual behavioral biases, things like loss aversion, representativeness, FOMO influence trading decisions at specific price points, and how that contributes to the very formation of support and resistance levels. We've also seen how volume reflects a collective conviction. That's essentially the market's overall psychological vote at these crucial junctures where price meets S&R. So given that market dynamics are ultimately the sum of all these individual actions and biases playing out, could understanding these psychological patterns, not just recognizing them in yourself, but seeing how they're reflected on the charts through support, resistance, and volume dynamics, could that be one of the most potent, yet maybe underappreciated advantages a technical trader can possibly cultivate?
That's a really interesting angle, looking at the chart as a map of collective psychology.
Exactly. Something to really think about the next time you open up a chart and try to decipher what the market might be telling you.